Just a year ago, many buyers were looking in the 7s or even the low 8s. That 1-point drop can translate to hundreds of dollars per month in savings, and for a lot of buyers, that's the difference between waiting or making a move. So what caused the decline? Some point to the Fed's recent quarter-point rate cut, and yes, that made headlines, but the truth is, mortgage rates have been gradually easing for nearly 2 years, even while the Fed was holding firm. To understand why, you have to look beyond the Fed and focus on something called the 10-year Treasury bond. Historically, mortgage rates in the 10-year Treasury bond move in the same direction, typically separated by a spread of about 1.75%. For example, if the 10-year yield is paying 3%, you could expect mortgage rates typically to sit around 4.75%. But starting about April of mid-2020, right in the middle of the pandemic, that spread exploded to over 3.5%. And that's one of the main reasons mortgage rates shot up to 8-9%, even when the 10-year yield didn't move nearly as dramatically. Fast forward to today, interest rates have cooled, market volatility is settled, and that spread is shrinking back toward its historical norm. That's why rates are falling despite the Fed's posture, not because of it. So let me give you a simple illustration. Today's 30-year fixed rate mortgage, as I said, sits around 6.38%. And if we still had last year's wider spread, that same loan would cost you about 6.73%. And go back to 2023, when the spread was near its peak, and it would be about 7.12%. So even though the Fed hasn't made any dramatic moves, the market itself is correcting the imbalance, and that's incredibly healthy for housing. This spread is tightening, essentially telling us that the bond market believes inflation is under control, and investors are comfortable accepting slightly lower returns, which translates to lower borrowing costs for you, the home buying consumer.